Good morning. I'm Tim Nyland, and today we're going to discuss the 10 reasons why so many semiconductor stocks, including some of the largest semiconductor manufacturers, are lagging the year-to-date performance of the Nasdaq 100 at a time when their products are in record demand and will be for as much as several years to come. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you would like to do the kind of analysis you're going to see in this video, then you need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor tools and the Zacks Research System. Let's go ahead and get started. On Labor Day, I saw this article on CNBC, and I found this article to be a little bit disturbing because this is really, really old news. I actually was able to trace back the start of tech giants developing their own chips back to 2016 with Google. And as far as the tech giants being in a big rush to develop their own chips, they've been doing this for in excess of 6 years now. So down here, I have a quote. Increasingly, these companies want custom-made chips fitting their applications, specific requirements rather than use the same generic chips as their competitors. Very true statement. So anyway, this particular article got me thinking about the importance of what's going on in the semiconductor space now, because many of the large semiconductor companies are actually lagging the performance of the Nasdaq 100. Again, at a time when their products are just in absolute unprecedented demand. So we need to dig into this a little bit more and talk about the real issue here related to this article. So a few things that I want to bring up before we jump in. Again, I did a webinar back in December 30th of 2020 called 4 Stocks to Corner the Semiconductor Market. If you haven't seen it, I definitely encourage everyone to take a look at it. Everything that I say in there still holds true to this day. The only thing that's going to differ are obviously the Zacks ranks a little bit, so just be careful of that. But the facts that I present in there are very material, and we're going to review a few of those right now. So back from that December 30th webinar, slide 4, and I have that original slide deck. If anybody would like a copy of it, just go ahead and shoot me or anyone on my team an email. There'll be information towards the end of this webinar for you to be able to do that. I talked on slide 4 about the chip industry consisting of basically 2 different types of designers and manufacturers, right? We spoke of special purpose examples, and then we spoke of the general purpose examples, and pay particular attention to the highlights here in yellow that I mentioned back in December, that this sample vertically integrated players category under the general purpose, which are just your basic, CPUs, GPUs, and your ARM processors, that consists of basically mega cap tech, right? This is the efforts of mega cap tech ongoing, trying to squeeze every last bit of performance out of their business models by marrying the chip design to their own software. And this is taking place not only on the hardware side, but obviously their software is being optimized for their own chip design. So it's definitely a vertical integration marriage, and it's helping to improve cost efficiencies as well. So keep that in mind. This is not new information. This is old information, right? So slide number 6, again, back from that webinar, I spoke of 2 things that you've got to consider when investing in the chip market, right? Number 2, I have highlighted here in yellow. I said stick with the majors and pay the toll so you don't get steamrolled by the push for more specialized chips and vertical integration. So we asked the question, with companies like Amazon, Apple, Google, and Microsoft eager to continue to basically design and develop chips that better integrate with their own software, how do you basically position your portfolios for that? So we move on to slide 13 from that webinar back in December. And I mentioned 4 stocks in this webinar to basically corner the chip market. Stock number 3 was actually a basket of tilt stocks. So this would be the basket of the ECP macro tilt stocks. I just have up here Apple, Amazon, Google, and Microsoft. And again, you must pay the toll. But consider all of the points that I made back in December, and I have them highlighted here in yellow, the important ones. They pretty much all stress the importance of vertical integration. So we can't ignore this, and it's got massive ripple effects that are now playing out in the industry, and that's what we're going to talk about here in just a minute. So Apple's new M1 chip, whether or not you realize it or not, it's actually built on Taiwan Semiconductor's 5-nanometer transistor fab, and it's literally setting all new performance standards in the PC market. And this is obviously being done with vertical integration, right? That marriage of the software with the chip and the operating system. Another shot across the bow was back in December, Apple announced it was going to begin using its own modem chips, right? So there was this evidence of more vertical integration with special purpose chips. Not only is Apple designing their new M1 chip and Taiwan Semiconductor doing the fab for it, but now we find out that Apple is going to go ahead and move forward with plans to use their own modem chips. So, this sent shockwaves across a lot of the Apple supplier stocks. Qualcomm, Qorvo, Skyworks, they all cratered on that news. And we're going to talk a little bit more about that here in just a minute. And then on December 14th, Microsoft followed up Apple with an announcement of an ARM-based, cloud server chip. So this is, again, Microsoft, stepping further into the ring and moving forward with their own vertical integration. Intel stock falls. So there's a lot of dynamics at play here that I need everybody to understand. So we need to, when we start going through these 10 reasons why so many of these semiconductor stocks are lagging the triple Qs year to date, start thinking about how all of this works together. And the last point down here, last 2 points, Amazon obviously started vertically integrating their own design of semiconductors with their own AWS cloud software back in 2018, right? And that was done by Taiwan Semiconductor. So I'm going to use Taiwan Semiconductor as kind of my primary example when we look at financial statements and such today. Just remember that this is the type of analysis and the mindset that you need to have in mind when you're looking at these companies as we go through these 10 points. The last point there is that Google research that I found from back in 2016, built on the Intel fab at the time. The interesting point about this was actually published by research at IDC, that Google purchased roughly 5% of all CPUs at the time sold on Earth, and those were vertically integrated chips as well for Google. So anyway, a lot going on, and it's been going on for years. It's nothing new. So let's see how this has played out year to date. Remember, we did that webinar back on December 30th. And what I did is I actually took out of the Advisor Tools platform, just did a price performance chart of all of the stocks that I named in that December 30th webinar. And I literally just plotted them against the Nasdaq 100 or the triple Qs. And I've got the Nasdaq 100 performance year to date circled here in red. And you can see that the only company that's actually leading the Nasdaq 100 is NVIDIA, right? I mean, for obvious reasons. The remainder of the group is lagging, and that's what we're going to talk about today, okay? Conversely, the basket of mega cap tilt stocks that I recommended, you can see that 4 out of 6 of those names are actually leading the Nasdaq 100, and by a sizable margin, okay? So here's your Apple, Amazon, Facebook, Adobe, Microsoft, and the Qs. Adobe doesn't get near as much press as it should. Adobe is orders of magnitude smaller than Microsoft, but they are also a cloud player and just as influential in the software market. And so a lot of what they have going on more or less mirrors what's going on at Microsoft. So keep that in mind as well. Okay. So the question that we're going to answer today is, again, why are most of the largest players in the semiconductor group lagging the NASDAQ 100 year to date when the demand for their products has never been so high? Again, we're going to go over 10 reasons. But before we discuss those reasons, I wanted to ensure that you did not miss our next Lunch and Learn webinar this Friday at noon. He's going to be hosted by Zacks Senior Relationship Manager and friend of mine, Meyer Thacker. So if you enjoyed my 3-part stagflation series, you will like Meyer's perspective on the inflation debate. Meyer will use tools and data in the Zacks research system and advisor tools to assess how accurate the forecast from June turned out to be. Then he'll analyze what the latest data suggests about inflation going forward and how that data will inform Fed policy over, say, the next 12 to 18 months. So you're not going to want to miss this one. Remember, it's this Friday at noon Central, and you can register for free at the link in the description below. So let's go ahead and move on with risk number one. And again, these are the reasons, I should say not risk, but reason number one of 10 why the largest members of the semiconductor group are lagging the Nasdaq 100 performance year to date. And I have a headline from a Barron's article, and this again goes back to that December 11th date that we already talked about a little bit, where Apple announced it will begin using its own modem chips, right? So again, this is that evidence of more vertical integration. Well, Qualcomm stock at the time tumbled during that announcement, and it actually remains down negative 5.87% year to date, okay? So this dates back to some events that happened specifically in 2019. To be even more specific, April of 2019 is when Apple and Qualcomm reached the settlement for the modem switching technology, and that agreement did not go in favor of Apple, and it had to do with the 4G, 5G, tower switching, and the fact that, without licensing the Qualcomm technology for modem switching, anybody that's trying to connect to a tower and connect with 4G and 5G, anytime there would be any sort of switch between 4G, 5G, or transition to another tower, the signal would be dropped. So Qualcomm's proprietary technology allows for that seamless transfer. So if you can imagine the importance of that, especially when we're starting to talk about autonomous driving and the need to maintain a connection, it's pretty important. So Apple, in retaliation, acquired the entire modem team from Intel in 2019. So it wasn't necessarily a surprise that this was the direction that Apple was going to be going. But again, it speaks directly to the risks associated with that vertical integration itself. So that's risk number one, when the company just literally outright says, hey, Qualcomm, you're put on notice. We're going to start making our own chips, or at least designing our own chips. And that's reason number one. Reason number two, we've talked about just a touch. There is obviously what I call vertical integration collateral damage risk, all right? And we saw this again, something that I paid particular attention to at the time of that Barron's article. And this is not just a Barron's article. I mean, this hit every press, Newswire, Business Week, Wall Street Journal. I mean, everybody had it. When Apple announced it was going to begin using its own modem chips, everybody turned towards Skyworks and Qorvo and said, uh-oh, that's not good for these guys. Keep in mind that both Skyworks and Qorvo specialize in RF filtering for 4G and 5G. So if Apple is trying to vertically integrate their product line, then what does that potentially mean for Skyworks and Qorvo? And obviously, both of those stocks tumbled on that Qualcomm announcement related to Apple using their own modem chips, and they are both lagging the Nasdaq 100 year to date. You can see the performance here. Skyworks up 18.45, Qorvo is only up 9.56, and the Nasdaq 100 is up like 21, 22%. Okay, so keep in mind the significance here is massive, right? And Skyworks and Qorvo, they have massive scale, but when you start talking about 30 and 50% of their revenues basically being derived from Apple, vertical integration collateral damage risk is real. And that risk is being baked into these valuations. So, knowing what happened already with Qualcomm, what is the risk to Skyworks and Qorvo? You've got to look at this collateral damage risk across the board. It's not just Apple. It has to do with Google. It has to do with Amazon. It's when you think of mega cap tech, I want you guys to think that is the tail literally wagging the dog of the entire semiconductor industry. They are consuming the most amount of this technology, and they are dictating the direction this technology is heading, whether you like it or not. So reason number three is obviously now there's a vertical integration push that's causing this industry consolidation, right? So we're seeing a lot of industry consolidation in the semiconductor space, a lot of acquisitions, right? And just take Skyworks and Qorvo as one example. They're trying to diversify their businesses and obviously grow up their own verticals, get into EV and other parts of the industry. And this is triggering mergers and acquisitions across the spectrum. These mergers are costly, right? The acquired firm typically has to be taken out at a premium. They take years to integrate, and a lot of them aren't successful. So these are just some of the most recent examples. There's obviously countless examples, but Skyworks, again, just agreeing to buy Silicon Laboratories here. This is going to close third quarter of 2021. Qorvo back in May, acquiring another company as well. But if you look at the history, I mean, they're just doing nothing but making acquisitions, trying to diversify their revenue base. Reason number 4 is pretty obvious, and I have the price chart up here for Taiwan Semiconductor. I mentioned earlier that I was going to kind of focus on some of those stocks that we had talked about back in that December webinar, just to keep the narrative going. Obviously, Taiwan Semiconductor is extremely significant for several reasons. It is the world's largest semiconductor manufacturer. They manufacture over 90% of the world's most sophisticated chips. So we need to keep Taiwan Semiconductor in play. And you can see that with the demand for Taiwan Semiconductor's products, you'd be shocked to learn that this stock has literally been trading sideways for most of 2021. Okay, so the geopolitical risk here is that the Chinese Communist Party literally considers Taiwan to be a province of China, and they've never actually ruled the island, but they've vowed to take it by force if necessary. So there's a lot of dialogue going on back and forth here. And this is a huge geopolitical risk, right? I've spoken with clients that have literally removed Taiwan Semi from their portfolios just because of this particular reason. So it is real, and something that you need to pay attention to. Okay. Reason number 5 and 6. These are huge, and these are related, and these are things that I really want you to pay attention to. Intel, right? Intel is the dark horse in this entire equation. The caption up here says it all, right? Good news for Intel is largely bad news for other semi manufacturers, right? So point 5 has to do with manufacturers. We're going to move to point 6. It's the same caption, but it's designers, right? They're two very different issues. Okay. So think about this from Intel's perspective, right? They're a chip designer and a manufacturer. They know that they're 2 years behind Taiwan Semiconductor on the traditional x86, their 7-nanometer platform. They are gaining ground on the design and the fab. Keep in mind that Intel is a crown jewel for the United States in the global technology sector, and it's a crown jewel because Intel's success is literally a matter of national security. If you think about, whose chips we're going to be using for all the sensitive government work and data collection, there is a massive interest in Intel's success here by the U.S. government. So the U.S. government is going to do whatever it needs to do to support Intel and its efforts. So when we start talking about manufacturers, right, we start talking about the 3 largest manufacturers in the world: Taiwan Semiconductor, Samsung, and Intel. Any good news for Intel, right, is going to be bad news for these other manufacturers. And I'm not including the Chinese manufacturers like Smithy and others. We just keep it to Taiwan Semi, Samsung, and Intel for purposes of this webinar. But good news for Intel, largely bad news for other semi manufacturers. Reason number 6, we move on. Same exact thing, but this good news for Intel is largely bad news for other semiconductor designers. Okay, the distinction here is that one of Intel's big problems and how they fell behind was they fell behind on both the design of the 7-nanometer fab and the actual implementation of the manufacturing process itself. So again, they're a designer and a manufacturer, right? Taiwan Semiconductor is a manufacturer, not a designer. AMD is a designer, not a manufacturer. NVIDIA is a designer, not a manufacturer. So I want you guys to understand how all this fits together. The reason why I have reasons 5 and 6 split apart is because of this second bullet point. It's very, very important. AMD and NVIDIA's successful market penetration of the x86 desktop and server CPUs has come at the expense of Intel's market share, right? So think about those companies that are eager to get back on board with Intel, right? Third point, if there's any good news on Intel, it's going to likely be seen as bad news for other semiconductors like AMD and NVIDIA. And you can see AMD as of late. Yes, it's had a tremendous run over the past couple of years. But again, with all the demand for their products and given the fact that they are literally chipping away at Intel's server business at every move, you would think that that stock would be a little bit higher than it is. And again, this is the reason why, is because you've got Intel in there. If they're putting out any sort of good news at all, look out for the designers AMD and NVIDIA because it's in direct competition. Okay. Reason number 7 is one that I want everybody to think about, and this is definitely being baked into valuations, right? So we've heard about this for the last year, how Taiwan Semi, Samsung, Intel, these guys are all in a massive race to bring fabrication capacity online as soon as possible. And it's such a race that it's even involved backing from governments, including the United States. These efforts are going to cost hundreds of billions of dollars. That's billions with a B, not millions, billions. And these efforts are going to be ongoing for years to come. The problem is that the semiconductor industry is cyclical, right? It is the most cyclical industry in the tech sector. And it's not going to change. Everybody says, oh, it's different this time. Well, that's when you run into real problems thinking that something's different. The issue here is that at some point, we're going to end up building up so much fabrication capacity that we're going to be potentially floating in semiconductors, in chips. And potentially within the next couple of years, I'm not going to say this is going to happen, but we don't know, right? The next 3 to 5 years, what happens when all of these companies with government backing have spent these hundreds of billions of dollars to build out all this capacity, right? They've bloated up their balance sheet with all this debt, and we roll into a recession and they can't give these chips away, right? These stocks are going to stand to get hurt badly. That's what recessions do to cyclical stocks, right? So there's risk here of an oversupply shock in years to come. So as soon as the buy side gets a sniff that we might be rolling into a recession, look out for some of these semiconductor names, okay? Reason number 8, cost of fabrication capacity build out is definitely hitting FY1 and FY2 EPS forecasts. You can see that we've got a Zacks rank sell up here, and you can see why, right? Estimates have actually been reined in. And it's quite shocking for the world's largest semiconductor manufacturer, who actually just announced a 10 to 20% price increase that's effective next year, who's actually got estimates on the slide, right? So this basically reflects the R&D and the capital expenditures negatively impacting those forecasts, right? Even though they can't produce enough chips because there's just so much demand for their products, right? Doesn't matter. When these forecasts start heading south, the price of Taiwan Semi or any of these stocks, I should say, the valuation is also going to just, more or less flatline. And we'll talk about more of this in future webinars as well. Reason number 9, the cost of fabrication capacity build out is hitting cash flows, as you would expect, right? So again, I'm sticking with Taiwan Semiconductor. This is literally an example of what you need to do with all of the semiconductor companies, right? Take a look at how their CapEx is ramping up. Is it driving free cash flows negative? Is it driving free cash flows after any promised dividend to common shareholders negative, right? In the case of Taiwan Semiconductor, again, outlining a framework for how you need to be thinking about this, take a look at the last several quarters in relationship to prior quarters and look at the ramp up in CapEx. Look at how it's impacting free cash flows, right? You can see that here. Notice they've got a dividend obligation. Obviously, they can't cut their dividend. That would definitely not send the right signal to equity shareholders. And you can see that it's actually driving free cash flow after dividends negative. Okay, so CapEx becoming a massive, massive drain on cash flows. And you can see that here. Absolutely love this cash flow analysis view. I created this view many, many years ago. And brought it into the Zacks research system. I just love the way that you can slice and dice through this stuff real easy. Would definitely recommend that you take a look at this if you're a research system subscriber. Okay, so this reason number 9, cost of fabrication capacity build out hitting cash flows. Then we take a look at that cash burn rate, and that has to be financed with something, right? So reason number 10 is you've got to look at long-term debt. And again, I'm using Taiwan Semiconductor just as a framework for how you need to be thinking about these things. And when you look at the long-term debt chart for Taiwan Semiconductor, you'll see why I'm raising a red flag. It's not that it's not justified. It certainly is, right? I mean, there's obviously demand for their products, but how much debt is Taiwan Semiconductor going to take on over the next couple of years? And what happens if we roll over into a recession at the point in which they're ready to fire up all these fabrication plants? So again, the analysis is, and again, we're just using Taiwan Semi as an example. You need to do this with all of the semiconductor stocks. Take a look at their CapEx, right? Cash from investing, that's the actual investment. There's two different ways I've broken out the cash flow statements here in this cash flow analysis. So I didn't circle cash flow from investing because we're actually capturing up here in CapEx. But what I want everyone to see is, again, the negative free cash flow after dividends. And then the debt financing comes in as a cash flow from financing. And that's really what's propping up the change in cash and cash equivalents here to be positive over the prior quarters. It would still be a little bit positive, but certainly it's being massively propped up by this huge amount of debt being infused into the capital structure of Taiwan Semiconductor. Okay, not a bad thing, but something that you have to be aware of, okay? So just as a summary wrap up, I wanted to put all 10 reasons for the underperformance relative to the triple Qs on one slide. I'm not going to go through these again. We've already done that. But I do invite everyone to request the slide deck for both today's webinar as well as the webinar that I did back on December 30th. All of this information is really, really valuable and will be super important for years to come. So that's about it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with advisor tools or the Zacks research system, or you're looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and zrs@zacks.com. Thank you all for watching, and I'll talk to you next week.